Nobody warned you when the internet changed commerce forever. In 1994, most people thought the web was a toy for academics and government researchers. Serious business people laughed at it. Newspapers wrote articles about why no one would ever shop online. Why would you buy something you couldn't touch from a store you couldn't visit over a phone line that took 45 seconds to load a single image? Then Amazon happened. Then Google happened. Then the entire structure of global commerce shifted so completely that the world before it seems almost unrecognizable now. In 2001, after the dot-com crash wiped out trillions in paper wealth, the survivors who quietly held on to their Amazon stock were called stubborn, delusional. The smart money had already moved on. The internet era was over, people said. It was a bubble and the bubble had burst. Except it hadn't. The infrastructure had just been laid. The real applications hadn't been built yet. The people who understood that, who saw that the crash had killed the speculation but not the technology, those people changed their lives. In 2008, while the global financial system was actively collapsing, a pseudonymous developer published a 9-page white paper about a peer-to-peer electronic cash system. Most people who read it thought it was an interesting academic curiosity. A few people thought it was the future. The ones who acted on that conviction quietly without fanfare, while the world was distracted by the crisis, those people built generational wealth. Here is the pattern. History doesn't announce itself with a press release. It whispers first. It whispers in technical papers that only engineers read. It whispers in developer forums that only builders visit. It whispers in niche financial research that only the most obsessive analysts track. And then one day, gradually, and then all at once, it stops whispering. And by then the early positioning is done. The window is closed. The opportunity has moved from the few to the many, and the asymmetry that made it extraordinary is gone. We may be living inside one of those whisper moments right now. Not because of a single asset, not because of a single analyst's prediction, but because two of the most powerful technological and financial forces in modern history are converging simultaneously on the same infrastructure problem. And the asset that sits at the solution to that problem is, right now, at a price that suggests the market hasn't fully understood what's happening yet. That asset is XRP, and the convergence is between the rise of autonomous artificial intelligence and the quiet reconstruction of global financial infrastructure. Stay with me. Because what I'm about to walk you through isn't hype. It isn't price prediction theater. It's a structured analysis of a technical and economic reality that is unfolding in real time and that most people, including most people in the crypto community, have not yet connected the dots on. Let me start with a question. When an AI pays for something, who handles the money? I know that sounds almost philosophical, maybe even a little absurd. But sit with it for a moment, because it is one of the most practically urgent unsolved problems in modern technology deployment right now. And the answer to it has enormous implications for where capital is going to flow over the next 3 to 5 years. Artificial intelligence systems are no longer just tools that humans use to get things done faster. That framing AI as a sophisticated calculator, AI as a really good autocomplete, is already outdated. The systems being deployed today are increasingly economic actors. They don't just answer questions, they take actions, they acquire resources, they negotiate terms, they initiate transactions, they pay for things. An AI system managing a company's procurement process doesn't just suggest which vendor to use. It contacts vendors, evaluates bids, selects the best option, and initiates the payment. The human set the parameters. The AI handles the execution, including the financial execution. An AI agent managing a content production workflow doesn't just generate text. It pays for image generation APIs, video rendering, compute, storage infrastructure, and licensing fees, all autonomously, all continuously, all without a human approving each individual transaction. An AI system running financial analysis for an investment firm doesn't just produce reports. It accesses real-time data feeds, pays for premium financial data subscriptions on a per-query basis, and executes the microtransactions that keep its information pipeline running hundreds of times per hour. This is not science fiction. This is happening right now in production systems at companies you've heard of. And here is the critical problem. The financial plumbing underneath all of that activity was not built for it. Your bank account, the infrastructure that sits beneath virtually every financial transaction in the developed world, was designed for human beings. It was designed around human behavioral rhythms, monthly billing cycles, biweekly payroll, quarterly tax payments, occasional international wire transfers that take 3 to 5 business days, cost between $15 and $75, and require a human to initiate them during business hours in the correct time zone. That infrastructure was an engineering achievement when it was built. But it was built for a world where economic actors are humans. Humans who sleep, humans who observe weekends and holidays. Humans who operate primarily in one currency, in one jurisdiction, at a pace that the human nervous system can track. An AI agent doesn't sleep, it doesn't observe weekends, it doesn't operate in one currency or one jurisdiction. A moderately sophisticated AI system executing real economic work can generate hundreds, sometimes thousands of discrete financial transactions per hour, each one potentially too small for a traditional wire transfer to handle economically. Each one potentially too fast for a legacy settlement system's overnight processing window. Each one potentially crossing multiple national borders and involving multiple currencies. Traditional banking infrastructure doesn't just underperform for this use case. It fails categorically. The fees alone would consume more value than the transactions generate. The latency alone would make the AI's economic function impossible to execute. So the question isn't whether AI needs different financial infrastructure. It clearly does. The question is, what infrastructure? And which assets it's at the center of it? That's what the rest of this video is about. The XRP Ledger was not designed to solve the AI economy problem. Let me be completely clear about that. It was built in 2012, years before the current AI revolution, with a completely different use case in mind: fast, cheap, cross-border payment settlement for financial institutions. But here's what's extraordinary. The technical requirements that XRP was built to solve the requirements of cross-border institutional payment settlement turn out to be almost perfectly aligned with the technical requirements of the AI economy. This isn't a narrative someone invented to make XRP sound relevant to AI. It's a coincidence of engineering requirements that has enormous practical significance. Let me walk through the specifications. Settlement finality in 3 to 5 seconds. The XRP Ledger confirms transactions and achieves final settlement in 3 to 5 seconds. Not 3 to 5 business days like an international wire. Not 10 minutes like a Bitcoin confirmation. 3 to 5 seconds, for AI systems executing economic activity in real time. This matters enormously. An AI making procurement decisions on dynamic market conditions cannot wait days for settlement. It needs to know in seconds that a transaction is final and irreversible. Transaction costs measured in fractions of a cent. The cost to transact on the XRP Ledger is approximately 0.00001 XRP, a fraction of a single cent at any realistic XRP price. For AI systems executing hundreds or thousands of microtransactions per hour, this is the difference between a payment infrastructure that's economically viable and one that isn't. If each transaction costs $0.5 in fees, an AI executing 500 transactions per hour is burning $250 per hour just in payment overhead. At XRP's transaction costs, that same AI is spending fractions of a dollar. Native multi-currency bridging. The XRP Ledger was built with a native decentralized exchange and multi-currency bridging capability. XRP can serve as a bridge currency between any two currencies automatically, in real time, without requiring a pre-established bilateral relationship between the sending and receiving institutions. For AI systems operating across multiple jurisdictions, paying vendors in multiple currencies, this eliminates an enormous amount of operational complexity. Programmable payment logic at the protocol layer. This is the capability that most directly addresses the AI economy use case, and it's called hooks. Hooks allow programmable transaction logic to be embedded directly at the XRP Ledger protocol level, not in a separate smart contract layer that sits on top of the blockchain, but in the transaction processing engine itself. A hook can be set to trigger a payment automatically when specific conditions are met. It can route a payment to the lowest cost provider in real time. It can split a payment across multiple recipients based on dynamically calculated allocations. All of this executes without human intervention at each step. For an AI system, this means payment flows can be as autonomous and programmable as the AI itself. The AI doesn't need to call out to a human treasury function every time it needs to execute a payment. The payment logic can be encoded at the infrastructure level and execute automatically in response to the AI's operational triggers. Regulatory clarity. This one is less technical but equally important. The XRP Ledger's regulatory status has been the subject of years of legal uncertainty. That uncertainty has been resolving through court decisions, through regulatory guidance, and through pending legislation in a direction that gives XRP a clearer legal classification than most other digital assets currently have. For enterprises and government agencies evaluating XRP as payment infrastructure, legal clarity is not a nice-to-have, it's a prerequisite. You cannot build enterprise payment infrastructure on an asset whose legal status is ambiguous. The resolution of XRP's regulatory situation is therefore a genuine and significant development not just for investors but for the enterprise adoption that this thesis depends on. When AI infrastructure engineers map their payment requirements against available options, traditional banking rails, other blockchain networks, stablecoin infrastructure, the XRP Ledger's combination of speed, cost, programmability, multi-currency capability, and regulatory clarity creates a specification match that is genuinely difficult to replicate. That's not a marketing claim. It's an engineering assessment, and it's why the enterprise and institutional interest in XRP as AI economy settlement infrastructure is real and growing. Let me make this concrete. Because the most important thing I can do in this video is move this conversation from abstract thesis to observable reality. The AI payment infrastructure problem isn't theoretical. It's happening right now in 3 specific industries that are already running into it hard. Industry 1. Enterprise. Procurement automation. Large enterprises spend enormous amounts on procurement, acquiring the goods, services, and raw materials they need to operate. The procurement process is a natural target for AI automation. AI systems can continuously monitor supplier markets, identify optimal sourcing decisions, negotiate terms algorithmically, and initiate purchase orders faster and more accurately than any human procurement team. Companies deploying these systems are discovering something unexpected. The AI is the fastest part of the process. The bottleneck is the payment infrastructure. The AI can identify the optimal procurement decision in milliseconds, but initiating the actual payment, moving money from the company's account to the supplier's account, potentially in a different country and a different currency, still takes the same 3 to 5 business days it always has. During those days, market conditions change. The optimal decision the AI identified is no longer optimal. The cost saving the AI found has evaporated. You've built a Formula 1 car and put it on a road with a 25 mph speed limit. The AI capability is real. The payment infrastructure is the constraint that's neutralizing it. XRP's 3 to 5 second cross-border settlement at near zero cost removes that constraint entirely. Industry 2. The AI compute marketplace. The infrastructure that powers AI, the GPU clusters, the tensor processing units, the high-bandwidth memory systems, is expensive, in high demand, and increasingly traded on dynamic spot markets. As AI workloads become more sophisticated, enterprises are moving away from fixed compute contracts toward dynamic compute acquisition. AI systems are beginning to purchase compute resources on spot markets in real time, buying capacity when they need it, releasing it when they don't, continuously optimizing their compute spend based on workload requirements and market prices. The billing and settlement for this activity is a significant operational problem. Compute spot markets operate continuously, 24 hours a day, 7 days a week, across multiple jurisdictions. The transactions are frequent, the amounts are variable, and the settlement needs to be fast enough to match the pace of the market. Traditional payment infrastructure handles this with batch processing, aggregating transactions and settling them periodically, introducing delays and accounting complexity that don't match the real-time nature of the market. Blockchain settlement, with its continuous, final, low-cost transaction capability, is architecturally suited to this problem in a way that legacy banking infrastructure simply isn't. Industry 3. AI to AI commerce. This is the category that most analysts haven't started modeling yet, but that may ultimately represent the largest volume of AI economic activity. As AI agent ecosystems mature, agents are increasingly transacting not with humans but with each other. One AI system pays another AI system for a specialized capability. A language model pays a vision model for image analysis. A trading AI pays a data processing AI for cleaned financial data. An orchestration agent pays specialist agents for task execution. This AI to AI economic layer is already emerging on blockchain networks, and it has a fundamental characteristic that makes traditional payment infrastructure completely unsuitable. There are no humans in the loop. There's no human to approve a transaction, no human to verify a payment, no human to resolve a dispute through a phone call to a bank. AI to AI commerce needs settlement infrastructure that is as fast and as programmable as the agents using it. It needs transaction logic that can encode complex conditional payment terms. It needs settlement finality that doesn't require human verification. It needs costs low enough that microtransactions between AI systems are economically viable. That description is, point by point, a description of what the XRP Ledger provides. Let's talk about the institutional dimension of this story, because the AI economy settlement layer thesis isn't just a technical argument. It's an argument that the world's most sophisticated capital allocators are already acting on, even if they haven't publicly articulated the AI angle. The institutional positioning in XRP over the past 2 years represents a qualitative shift in how this asset is perceived at the highest levels of global finance. This isn't retail speculation. This is systematic accumulation by institutions with billion-dollar research budgets and risk management teams that spend months stress testing any significant position before it's approved. When a major global investment bank builds a 9-figure XRP position, that position has been through layers of analysis: fundamental analysis, regulatory analysis, liquidity analysis, competitive analysis. The decision to allocate that much capital to XRP means that every major objection, the regulatory uncertainty, the competitive alternatives, the adoption timeline has been evaluated and found manageable or resolvable.